One, welcome. Sorry for that delay. I got some audio issues. Hopefully everything is good to go and you can hear me fine. One of the things I'd like to ask, if you're open to it, is we've got a core group of people that come consistently, and I'd be curious to know exactly what it is that you value most out of these presentations, and if you're willing to just type that into the questions so that I can focus on that a little bit, or things that I could add into the presentations. For the most part, they're pretty consistent, as we're just talking about, the markets. As the markets are flowing and changing, they're always changing. And so each Tuesday, Thursday, we're able to talk about that and where we're at and what the strategy should be going into this next few, 2 or 3 or 4 or 5 days as we move through this. So I'd be interested to know what it is that you find interesting, what is helping, what you need more information on, and we can improve that information for you. Let's jump into market conditions. Directional alerts, we're sitting, again, this is the long-term perspective, so this one changes very, very slowly, and we know that we've been topping, we've retraced, and now we're starting to work back up this direction. This is that long-term trend. We're at the upper end of that range, and now the question is going to be, what is this? What does this pullback look like, or what does this counter trend look like, or what is a entire reversal look like? And in terms of the overall condition of the market, we know that that is the higher probability right here is that we go flat to kind of sideways to retracing a little bit, or the lower probability is that we really moonshot even higher and continue this overall trend. But that being said, that is the most bullish scenario on this uptrend, is that we're pulling back, we're breaking out, but we're due for some kind of a retracement counter trend, even in the short term. Sentiment's up the upper end of that range, buy-sell ratio starting to curl back a little bit, but still bullish. And so we've seen this before. We've seen that we oftentimes on this initial move higher get a retracement, and then a little bit higher move. Even if they're not real strong moves, they're typically not straight up and straight back down again. This one was kind of close, but even then we still had a retracement and then a push higher. This one we had a retracement and a push higher, one more and then higher. Each one of these over that length of time. So when we look at this and we say, okay, we're right here, then more than likely we're gonna be looking for a retracement and then some kind of a move back up. That, again, that's more than likely. It doesn't mean it's going to happen. So what we want to be watching is to see, today could be a rough day. We'll see how this gap higher and fade, everything's kind of fading and selling. We're seeing significant sell-off in commodities right here as well. So we'll take a look at that. So overall market conditions, we're at the upper end shorter term, we're at the upper end long term, and we the market's kind of priced for perfection right here, and we'll see if we end up getting that overall scenario. We also know that this big economic boogeyman is still floating out here, and that is this inverted bond yield curve. I covered it last week. I won't get into it a whole lot, but this is one of those things that it can stay like this. If you go back to the 70s and 80s and high inflation and stagflation and interest rates were 15 to 19%, and we just continually had really high interest rates, that's a possibility. So that's one of the discussion points I've been hearing, is we just got to get used to living this way. Got to get used to living with higher interest rates. We've been spoiled for 20 years, and those days may be gone. They may not be gone either. It's like it's really hard to know, but at the same time, we're just not seeing a slowdown in inflation. And the Fed is going to have to decide what it ends up doing, and that was a part of the reason why the market may be selling off. There was some discussion, some Fed minutes talking about higher for longer. Now, higher for longer stance meaning higher interest rates, these shorter term interest rates staying higher for as long as it takes to break everything, is really what the Fed wants to do. And they've always done their job in terms of breaking things, and it's going to happen here. It's just a matter of time. But what we don't know is how significant that retracement, break, downturn, recession, slowdown, call it all of those things. We're at the location where we definitely want to be having these talking points. Now, we've talked about this for really all year, because we've been sitting at the upper end of this trend from here to here. This is January right here, and we just kind of were gliding, had the retracement, and we're sitting right here. So when we look at this chart, it is quite, it's a good looking chart. It's a bullish trend, and so we don't want to get crazy when it comes to fear either. And so it's easy to do when we get a few days of panic, or we get a big retracement day, or we get some kind of economic news that's going to be negative, or earnings that are negative. Lots happening right now. This is a chart of S&P 500, so SPY. We want to just have this support area pulling back, this 525 range sitting right in here. There's a gap right here, could be retested. You can see we gapped open, and now we're trading lower, and that could be, it could be a day like this, could be a day like this. We're now in this overall uptrend, just like that. So any pullback, I still think there's some FOMO, some buyers that are in there that want to come into the market. But again, things are changing quickly in terms of the perspective of the economy. One of the things that is going to mean is higher interest rates. What we are seeing, gas prices maybe trading a little bit lower. Let's jump over. Let me go back to that point, is that we're dealing with companies slow down now. And so this earnings season is almost over, but as we get into the next earnings season, so we're going to have a little gap right here, kind of a void. Historically, the end of May, beginning of June traditionally is decent. But summer may be slow here as well. A lot of this is going to be based on perspective of, again, same thing, interest rates, inflation, and AI. Okay, we had NVIDIA's earnings today, or yesterday rather, NVDA, and up 10% today. So it's gapped higher. It's continuing to move. So it's a good example of an amazing company with just the technology right now that is happening for these guys it's phenomenal, the amount of what they're doing in their earnings. And I think they announced a 4 or 5-for-1 stock split, as well as a dividend increase. So that stock split will be welcome for a lot of people. And a lot of times that, you get a stock split 5-for-1. I need to verify that. I think I just saw a headline. I'm not 100% sure on that, but it's that I believe that was the case. That takes it back down to $200. Now, a stock split, if you're not super familiar with what that means, a stock split is basically if I have a $10 bill, and I go up to the cash register and I say, hey, can I trade you this 10 for 2 5s? And they say, yep, sure. I have the exact same amount of money. I just have 2 bills instead of 1. And so now what they do is a stock split. If it's a 5-for-1 stock split, that means that they just divide this by 5. Okay, so 200. So as of right now, if they were to split it, and if we owned 10 shares at 1,000, okay, then we're going to own 50 shares at 200. But it's the exact same value. Our value doesn't change. We're just able to, and this is all window dressing. It just allows more people to buy in, and it's more of a perception than it is anything else. You have some companies like Berkshire Hathaway. They're like, who cares? We're just gonna, the value of our company is $150,000 a share. Buy it or don't buy it. If you can't buy it, then so what? It's some perspectives are like that, where in a stock price at $1,000 is removing a lot of people from being able to buy into this stock. So that's that is a reverse stock split is just the opposite, is where you have usually it's a stock that's just been obliterated and it's worth like 30 cents, and then they do a reverse split of a 1 for 10, and it bumps it up to to $3 or something like that. And now it allows that companies to be relisted, or various things happening. So stock splits and things are really insignificant other than the perception. Let's jump back. So point being, we're still seeing this part of the economy work. What I'm really going to be fascinated by is how companies start to utilize it to become more and more efficient. And that really is going to be the key, is can companies actually use AI technology to be more efficient and more profitable? That's all the stock market cares about. Is a company profitable or going to be profitable or not? And how much? Can it be significantly profitable? Can it grow? Is it growing? If it's not, that stock price is going to be flat or go down. So ultimately, a company has to have something cool or good or useful that consumers want, and they're spending money and they're continuing to move higher. Or business to business. NVIDIA is a business to business company. So you have Apple, you have Microsoft, Google, all of the big heavy hitters are buying chips from NVIDIA. So these guys, everyone that's loading up on their infrastructure is buying. They're buying from NVIDIA. So that's one of the reasons why it's been such a fantastic move higher here in this last year. Let's jump over to the, let's see, let me just come back. I wanted to cover bonds again. I covered those briefly this morning, but I know sometimes that's, not everyone can participate or view that. But let's just talk about this pattern on bonds. This is an interesting pattern right here because we've been in such a nasty downtrend in bonds. If I come out for a couple of years, this is TLT, and as bonds are continuing to move this direction, that means that interest rates are moving that direction. We know that, okay? We obviously know that's been the case, but what we want to start to wonder, concern, or be interested in is this the new trend, counter trending, and it's going to hit higher? Or is this the overall trend still? We're going to counter trend up and we're going to continue to move lower. Bonds can certainly move lower. Interest rates are still only 6-7%. That, if inflation stays up, we could get 8, 9, 10%. Interest rates can go a lot higher from here. But they can also go lower. So we want to watch these patterns and these trends. This is a significant downtrend that needs to work through that, and that's going to take some time. And that's the attempted bottom now that we're looking at here. If I remove that volume, you can see it's working its way back up to this trend, but it's done this before. It's tried to start a new trend, but ultimately it is such a strong downtrend that it just can't break through that. We'll see if that's the case right here. This is an important chart to keep an eye on, in my opinion. That's why we'll continue to discuss it each time, each week. Also, one of the things I wanted to cover today is ETF allocation. Now, we use a lot of ETFs. I like them because they're tradable. Okay, you can jump right out and say, oh, I want to buy the S&P 500. Here's SPY. Bam, pull the trigger. Done. I'm now in the S&P 500 by buying just the SPY. Trades just like a stock, really easy to get access to. So as you're trading and as you're finding that depending on your risk level, depending on your ability to manage a larger number of positions, or be able to really keep an eye on a lot of positions, if you're finding that to be more and more difficult, one of the ways to work against that is, or to what's the word I'm looking for? To utilize a different strategy other than stocks, is to utilize ETFs. Okay, so we've talked about these before. Essentially, an ETF allows you just like this. So you'll notice I'm over here now. I've moved over to this muscle ETF scan, ETF weaklings, and notice what is in here right now. Okay, a whole load of energy bull 2X. A lot of these are inverted. Okay, they're in the downtrend. So now you've got USO, which is moving lower, oil moving lower. And all these companies, for the most part, these are just different companies offering the same thing, whether it's ProShares or whether it's Direction or whether it's whoever the company is. So a lot of these are similar. So USO, in this case, it's an ETF. So if I wanted to, in this case, I don't know why I would want to own oil to be bullish. It's kind of one of those things where it's moving higher, but ultimately it's a commodity, and that's more of a tradable. It's more of a tradable instrument. And so you can focus on some of those over that long time frame or the shorter time frame and say, all I want to do is own oil, but I don't want to own the futures, or I don't know how to trade futures, or I don't want to open a futures account. I just simply want my basic brokerage account, but I want to be able to participate in other areas of and other asset classes or other vehicles that I may not have had access to in the past. So ETFs are a great way to do that. So one of the things that you can do also is narrow that down and say, I want to own pieces of the market. I don't want to own the entire market. I only want to own the best performing pieces of the market. So one of the things to do is, and I've built this, well, you can use this sector ETF tab. You could also build out your own watch list of these ETFs. I've got one here that is sector ETFs as well, so that you can add those in and keep an eye, because you can have different things where you're dealing with these inverted, these long and short and different things there. But as far as the long side, if you're saying all I want to do is focus on areas of the economy and I want to overweight my portfolio in winning directions, then I can say I'm just going to focus on the ETFs of these certain areas of the economy. Let me go back to this tab here, since I know you've all got access to that one. And then I could say, what are the highest ranking sectors? Okay, it's going to work the same. The ETFs are ranked by other ETFs. So it's going to be ranked by the performance against other ETFs. Now, it gets a little bit skewed. I wouldn't say skewed, but there are so many ETFs that are leveraged now, the 3X and all of these things. So those, a lot of times when you get real big performance, it's because they're already leveraged. And so they're going to outperform a non-leveraged ETF. Leveraged meaning 3X. S&P goes up. Well, let me go back to this. S&P goes up by 1%. Then inverse ETF, this one goes down by 3%. So obviously this one's going down. But there are also leveraged ETFs where the SPY is going up by 1%. Then I could buy an ETF that goes up by 3%. I can leverage. So I still am taking I'm able to get a little bit more bang for my buck, but I'm not buying individual stocks. So my point is, if I don't want to try and have to pick an individual stock that's moving in a certain direction, I just want to try and get into the group or trying to get into the sector that is moving that is the strongest right here, then this is one of the ways to do that. And I could say, okay, I want to own technology until it stops working. I'm buying the uptrends in technology, and it's as long as my rank has continued to be high, then I know that this is going to include all of the technology companies that are available. You can go out and do a little bit more homework on which stocks are included. A lot of times you can go out here and maybe go out to Google or to the news tab and do a little bit more and say, these guys are doing, they've got 500 stocks or 100 stocks or 300 stocks that are included in that overall portfolio of stocks. And an ETF really is just a portfolio of stocks. And so that's one of the ways to be able to reduce the amount of volatility and reduce the amount of stress and homework and picking stocks, because it is an easy process, but at the same time, it's not an easy process to be able to which one am I focusing on. We obviously know and try and make that as easy as possible. Here's our leading groups. Here's our strongest stocks, but we get a lot of volatility. Which one should I focus on? Should I focus on medical or biotech stocks like Novavax had a massive run up? Or do I focus on pick the individual stock instead of saying I just want to own the leading sector, the top 3 or 5 leading sectors right now that have buy signals or that are in uptrends. That's one of the ways to be able to do that, utilizing ETFs. They're a really great instrument to be able to utilize, but at the same time, they are not individual stocks. Because they are so diversified, they may not have the performance of an individual stock. So there's pros and cons, but in terms of volatility and in terms of market conditions where we're at right now, and saying market conditions are pretty high right here, and I may want to start to hedge against some kind of a downturn. We've talked about this at just about every market every time we've topped out right here, and that is there are 2 ways to hedge in the stock market. Well, there's more than that, but the 2 most common are, number 1, don't be in the stock market, be in cash. Okay, that is a guaranteed hedge against the stock market, is don't be invested. It's that reward to risk. Well, I don't want to miss out on potential increasing gains in my overall capital. Okay, let's come back to this chart. But I also want to say, I want to be prudent in the risk that I'm taking, which means it's a rebalancing process. And that rebalancing is a slower moving process where I could say we've done really well. Maybe equities maybe I start to reduce. My exposure was 50-50, 50% stocks and 50% cash. Maybe I start to reduce that exposure to 30-70, 30% stocks, 70% cash, or 25%, okay, and 70. It's reducing the risk. A lot of times when you're watching, if you're watching financial TV and they say we're reducing our exposure, okay, this is all they're doing is they're saying we're just removing the exposure of risk or downturn into something that doesn't have that exposure. It doesn't have that risk. It has a different kind of risk, but that is inflationary risk, and that is if you leave your money in a bank account for forever, you're going to just be increasing with the rate of inflation. And that's okay too, because you're guaranteeing that your capital plus a little bit of interest is going to be there. And in a lot of times, that's good enough for me. That's good enough for most. That's good enough for the gains that I need, particularly if you're in a certain phase of retirement where I just can't take additional risk with this capital, or I couldn't afford to have a 20 or 30% drawdown on my entire account and then try and recover some of those losses in over time. So these are areas where we say a rebalance or just a readjustment of risk to say that because we're dealing with probabilities. What are the probabilities that we keep moving higher from here? It's definitely possible, but it's never different. Okay, every time we deal with one of these things, whether it's .com, subprime, COVID, stimulus, overstimulus, and then this move here. It's always this same process. It's just different players. We're dealing with different stocks. We're dealing with different companies. We're dealing with different Fed chairmen. We're dealing with different Congress and Senate, and all of these things. We're dealing with different technology and companies. But the greed and the fear cycles are always the same, because we as human beings, we just are not going to change. Our greed and fear mechanisms are so Neanderthal that they are probably stuck in our brains that way forever. And we're just a herd. We have a herd mentality. We jump on the bandwagon when everyone else does. And at some point, the music stops in the musical chairs, right? And there's not going to be a chair available. And we want to make sure that we're in a position that if we have that reverse, we have that risk, we have that retracement or drawdown, that our accounts are not set to explode, okay, or to have really significant drawdowns. Drawdowns are going to happen. Okay, that's just a part of taking additional risk and trying to get more return with that capital. We have to take a little bit more risk, and that risk means volatility typically. Okay, it's kind of a soapbox here because I know market conditions. We're just dealing with dislocation, and we're seeing a lot of stocks that have been working, but we're seeing a lot of stocks that haven't been working, and we'll see how this ends up turning out. It's a great position to be able to just adjust those overall risk positions. That being said, we've got, it happens slowly. It doesn't happen overnight. And so we can watch these bars. That's part of the reason why TradersPro is an end of day, 1 day bar only. Okay? We don't have weekly charts. You don't have 5-minute charts or 60-minute charts, because the system is designed to be a 1 day decision making point. I'm going to make my decision based on today. I'm going to allow that day to unfold, and then I'm going to reevaluate going into the next day. There's two important reasons for that. Number one is it creates a controlled system. You can't say, oh my gosh, this thing's let me jump into the 5-minute chart and see what the 5-minute chart. Are we going to bounce right here soon? Or let me jump into the 60-minute chart, or let me look at the weekly chart. I'm not saying that isn't valuable, But that's a different system. That's a different mechanism. When we get confirmation bias is when we're looking for information to confirm what we think should be happening. Okay, and so we constantly will to move to an indicator or a time frame that confirms what our bias is telling us, and that's not always good. It happens in a lot of different things. It happens in a big one is religion, because none of us want to believe that we're wrong. Okay? And so we're always looking for confirmation that what we're doing is right, even though we may be wrong. We're gonna, that's why there's all these crazy blogs and podcasts and video that, back in the Q scenario where you had QAnon and you had this, these people just getting sucked into this belief system. And we can do that now with the internet. We can go down rabbit holes. And I don't know if you ever watched I don't remember the name, but it's a Netflix series that talks about social media and the algorithms. The algorithms just feed what we're already doing. They allow confirmation bias times 1,000, because that's all they do is they feed us stuff that we're already looking at or researching or watching, and then we get more, and then we get more, and then we get more, and then we start to believe the world is flat. Okay, so it's an interesting time to deal with information and how we're processing it and how we are enabling it. So that's one of the cool things I like about market data when it comes to just flat out price data. Yes, you get big heavy hitters that can move markets, but at the same time, this is the live real-time decisions of every player on the planet right now. Okay, every player on the planet that is interested in the stock market, the US stock market, the S&P 500, they are making decisions right now. And if the decisions is, good Lord, let's get out, you're going to start to see that. Okay, and then we will also say, oh, looks like, it looks like price, it looks like the market is saying whatever that consensus is of everyone at the same time, it's moving down. All right, well, we're going to trust that decision making of the entire market. And that's really the essence of price analysis, is allowing the entire consensus of whatever price activity we're looking for, whether that's stocks or bonds or real estate or cars or baseball cards or cattle or anything that has a market driven mechanism. It's a buying and selling mechanism, and it's instantly price discovery is happening right now. So we're able to look at today and say, all right, what's today doing? This is a pretty bearish bar right here at the top end of the range. And then we can add some of these other analysis that we look at. We can say what is our 30,000 foot view? What's the big picture? We know that. What's the short-term picture? We know that. What is the economic perspective that typically is conducive for stocks moving higher or not moving higher? We know that. Okay, and then we've got to place all those puzzles and decide what's our risk tolerance? What's the time before we need this capital? Is it helping our lives? Is it hurting our lives? Is it, those are all decisions that come into play, and that's our job to be able to focus on that. And TradersPro is just a tool to be able to condense some of that information and allow us to help make decisions based on a lot of information that's out there in the world. Let me just summarize here. Let's go back again. That's really the situation we're looking at. We talked about ETFs, how to utilize those. One of the ways to be able to diversify at more of a micro level or a fragmented level is just focusing on these sectors of the economy that are continuing to move. And those are always ebbing and flowing. Those are, you get basic materials, you're getting energy, you're getting technology, you're getting financials. I think financials are getting hit pretty hard today. So financials moving lower. Financials are going to move lower if they are anticipating that interest rates don't move at all, because financials need interest rates to go down. As you think about this right here, they're lending money out right here at this rate, and they're giving this rate to savers, checking account, savings account. They're losing money as long as they have an inverted yield curve, and the perception of it staying longer is going to hurt some financials. So some of those things are taking place now, as and we don't have to know all the details either. We can simply say, well, they're dropping, they're retracing. Or is it early? Is it late in the trend? Why could they be moving higher? Why, you know, we can ask the whys and we can conjecture, and that's fun and that's interesting. But when it comes right down to it, they're at the upper end of the range, running into resistance. We've had 5, 6, 7 weeks of uptrend. It's due for a pullback. And we could say, that's all it is. It's just profit taking. It's just selling because people are locking in some gains, locking in some profit. Those kind of sells, those kind of retracements are actually positive for the market because it allows for buyers, it allows for a reset of a new supply demand zone. A supply demand zone is just simply locations where you now have resistance. Resistance creates supply. Okay, supply is additional shares. People are selling the shares. When there's more shares, there's nobody buying them, you're going to get a retracement. Once that demand stabilizes and you get people that are like, oh, this is gone too far too fast, I'm ready to step back in again, then demand comes in and it starts to shift back up. Each of these levels are supply demand zones as well. So and where it has been at before. Okay, so if we were to draw a line here, we've been here, we've been here, we've been here and failed, we've been here and won. Okay, so now we're looking at, we're now back to where we've been and we won before, or the market won. There should be some support. If that starts to break down, then we can say, okay, something's up. Trend is starting to shift. Is it going to curl back up, or is it going to fall off the table? The yellow helps us make that decision. Okay, the trend is pausing. What is happening right here? Is it an opportunity for us to buy into the dips? Well, our methodology is, well, we need to wait. We need to wait just a little bit. We need to wait just a little bit for some confirmation for that to continue to move higher. Okay. I appreciate your comments and feedback. I've got a few different comments back in here, and I do appreciate it. I'll read through those, and I'm going to end on that note. We'll see you next week on Tuesday. Everyone have a fantastic weekend and enjoy your day today. Thanks a lot. Bye now.